Hello traders, welcome to AkhenatenFX. This is a technical analysis channel focusing primarily on the Forex market. My market approach is based on the concepts originally introduced by ICT. That's the Inner Circle Trader. If you haven't heard of him, you should look him up. I post pre-market outlooks, post-market recaps, and discuss topics trading related from risk management to psychological conditioning, as well as provide an intuitive understanding of the market and how it behaves. Today, we'll be doing a short introduction into some basic market concepts. I'll be covering things such as liquidity, time and its relationship with price, as well as structure. Now, I'm well aware that these are all concepts that exist on other avenues on the internet, and likely not the first time you'll be hearing of them. I hope to provide an explanation that might help these concepts be a little more intuitive so that when you're looking at a chart, the understanding is right there as opposed to having to remember something that you might have learned but does not appear in your mind when you're in front of the charts. Now, there are some basic assumptions that need to be made in order to apply these methods. The first assumption is that the market is not random. If you do believe the market is random, then there is no reason for you to be even engaging in this exercise. If the market is random, it would be impossible to predict. It would be impossible to predict with any sort of certainty or any sort of risk management. And essentially, you would be gambling, and the house always wins. So if you do believe the market is random, trading is likely not a exercise that you can justify. Now, I believe that there's an algorithm that's responsible for price delivery, and this algorithm moves the market in a balanced fashion, seeking liquidity. Now, what is liquidity? Well, to understand what liquidity is, we have to talk about price action. Price action is your chart. It's the lines you see going up, going down, printing. That's what price action is. And what price action is a visual indicator of what price is being offered to the market as a function of time. So essentially, what price can you buy this asset for at this time, shown as a line graph, represents price action. Now, at every historical price point in the market, there are buy or sell orders that were opened at market price during that specific time. So just to give a visual, with the price action that we're all used to seeing, as price trades and moves around and does its thing, market participants are being offered particular prices at certain times, and they are placing orders either buy or sell into the market at every price point along here. Now, I'm going to draw this line to represent time. And time marches forward in a steady pace that we've defined to be seconds, hours, days, months, years, and so forth. And price is offered at a certain price relative to time. Now, as I had said before, I do believe that there's an algorithm that's responsible for delivering price in the market. And this algorithm does so to deliver price to the major market participants. And these are those with enough significant liquidity. So those would be your banks, primarily your central banks, those that actually have or own most of the liquidity that's in the market. So the algorithm does this by moving price to what I'm going to refer to as points of matched liquidity interest. Essentially, price is matching both buyers and sellers and is moving to meet them at prices at which they can do business with each other. Now, this is not determined necessarily by where people want to, say, take profit. Primarily, this is defined by where people are forced to exit, because when you trade, you have a higher probability generally of being wrong than right. Essentially, the market knows for a fact where your entry is and knows that your stop loss will eventually be placed around those areas. Your take profit is largely hypothetical and generally a much wider range of the current price than what your stop loss is as you wish to make a profit. So, touching on structure a little bit, I think it's important that people unlearn how they've been thinking about structure. Essentially, my belief is that there is no such thing as market structure. There's only a footprint that's left behind by liquidity and liquidity seeking. Structure is simply an inference that we as observers are making and is not a true market reality. Essentially, you don't want to get lulled into a false sense of security because what you believe to be structure has formed. Every single point on the chart represents liquidity, and every single point can be traded into by the market. So on the left, I have what we know as bearish structure. As you can see, price continues to move down in a bearish fashion, and the lows are violated and the highs are not. The only reason price is moving like this is to achieve what's known as a liquidity target. This can be in the form of a higher time frame imbalance. It could be an order block. It could be below a previous low. All that matters is that there is a reason price wants to move here. And as it does so, it leaves behind this footprint of efficient price action on its way there. We refer to this as structure. As you can see, the same is true for bullish. There is a liquidity target. That is to say, a reason price wants to continue to move forward. And as a result, when it gets there, the footprint it left behind is what we refer to as bullish structure. Now, the last concept I want to talk about before we look at some live price action is the relationship between time and price. Now, if we look at these four charts, obviously there seems to be a difference, a pretty large difference between the ones on the left and the ones on the right, both of which can be said to move in what one could consider an unpredictable fashion. However, if you look on the left, price does not respect time. Price goes back in time here, and it does it again here, and does it again here. And as you can see here too, price does not respect time. Here on the right, price moves through time forward in the way that we are used to it. So this is a somewhat simple, however, very powerful understanding or concept. Price essentially has two directions, up or down, and one direction through time. Price does not go back in time. Price, you cannot have bought an asset at a different price point at the same time. Only one price point is offered at any given time. And what this means is that when we look back, we know for a fact that there are orders at those relative price points. If we zoom in to this and treat it as if it were live price, we understand that as price or as time moves and price is printed relative to time, we know price points at which participants were given the opportunity to engage with the market. So at this point in time, nobody who wanted to buy or sell could have done so at anything other than that price. And the same would have been true here. The same would have been true at every single point on the chart as time moves. Now, as a market participant, you don't know where price is going to go next. All you know is what you have prior to you. All you know is what rests beneath the highs and the lows is liquidity. And the reason liquidity rests there is that even as people don't buy at the low is usually where stop losses will go if you're long, and the high if you're short. And this is on all time frames. Essentially, in order to be a profitable trader, what you need to do is enter a position and exit it in profit. There's no such thing as a perfect entry because the market will eventually retrade to all price points. A perfect entry is only defined by where that entry was exited. Now let's take an example. Let's say you're looking at this market and you wish to sell it, and you're watching price as time moves forward. And for whatever reason, when price reaches this point, you decide that this is where you want to sell the market. And so you sell it. As price moves, as time moves past that point, as it turns out, you sold at what was a peak. Good for you. And time continues to march on and price prints as it does. And as time reaches this point, well, you've been stopped out. That was a bad trade. It did not succeed. And you would be stopped out essentially right here as price trades to that price point again. And that's assuming that you'd moved your stop loss to break even as a risk management strategy. Obviously, if you did not put a stop loss, you would still be in this position and you would be in drawdown. Now, replaying that scenario as time moves forward, if you had sold, say here, or bought back in here, you would have captured this price and you would be in profit. This is to illustrate that your entry is only defined as a good entry by how your exit is defined. So if you're taking trades and you don't know where you wish to exit, then what you're doing is essentially gambling. You, for some reason, think that price will continue to go in your favor. I'm here to tell you that that is not what is going to happen. Both your entries and your exit need to be defined in order to have a valid trade. Liquidity is important because the market seeks liquidity and will behave differently after having achieved liquidity. So essentially, for instance, here on this chart, below this low would have been sell stops, because as time came and offered this price and individuals bought here, and as they continued to buy at the best prices offered after price had traded here, they would begin to pile their stop losses here. And the market will return here to hit those stop losses. Now, if they bought here, then for them to exit their positions, they have to sell. And so that's why these are sell stops. Now, if I wanted to buy, the best time for me to buy would be to buy from a seller. Why? Because a seller is going to offer me the best price to buy. Someone who wants to get rid of something is going to offer me a very good price to buy it. So these people who bought here, when they're sellers here, that's when I would look to buy. And as a buyer here, I would look to sell to people who wish to buy. Essentially, as a buyer here, I need to sell to exit my position. Now, the best place for me to do that would be above these highs, because people who were short here, well, they're going to have to buy back in to cover their position when price trades back. So if I'm a buyer down here when price returns here, and a seller here when price returns here, then I would have made a profit. And that's essentially how you profit in the market. All right, now we are looking at NAS100, and we're going to do just a short recap of last week's price action and take into consideration some of the concepts that we learned earlier and use that to interpret price action. And then we're going to look at what my outlook for next week is and go into a little bit of some of the concepts that I use to produce my outlooks. Now, what an outlook is to me is not a trading signal. I don't trade off my outlooks. What I use outlooks to do is to set market expectations. During the week, I look at price action and see how price is reacting to that outlook. Sometimes it's in line with it and sometimes it's not. However, both of those can give you relevant information to what the market might be trying to achieve. So essentially, outlooks are a reference point at which to interpret the market price action during the course of the week. So here we have the 30-minute chart of NASDAQ. This represents the trading of last week. Now we're just going to zoom in here a little bit to look at what price achieved. So right here, this line, this denotes the week, the open price of the week. Sunday, 22nd, price open here. This first box represents the Asian range, and the second box represents London's range. New York is not closed out by a box, but essentially everything between London and the next day Asia is New York. So quite obviously, this ended up being a bullish week, as you can see. But if we look at the liquidity story of that week, we can see that price opened here and started bullish early. Now you have to understand that, as mentioned before, only the price offered along here relative to time was where people could buy. So essentially, there were individuals that were long, essentially from the weekly open throughout the week. Over here on Wednesday, New York session, we can see that price traded below the open point. Everybody who was long here, whether or not they went long at the open, whether or not they went long somewhere in here, would have been underwater or stopped out by price trading here. And that is what we refer to as sell side liquidity. So essentially, the market opened, it ran up during the week, it came and captured sell side liquidity, and then it finished strong. Something else to note is that as the market traded down here, we would have had buy side liquidity building up here. And as you can see, this was taken. So essentially the market succeeded in capturing major sell side and major buy side liquidity during the course of its trading this week. If we look at where the market terminated, as you can see, I have buy side taken denoted there. That is because on a different time frame, this high represented buy side liquidity. Looking on this time frame, everybody who has been short between this point and this point were not offered a better price to go short from. And by price trading here, it has put all short positions underwater that were open between these 2 points in time. Going back to the 30-minute. As you can see, I have an overall bearish bias for next week, though I do think we can continue to see some higher price action. Next week is NFP week, so we can be expecting some expansion of the current range as the week closes out on Friday. So I'm going to do a very quick top-down analysis. Some of these concepts might be familiar, some of them might not. This video is not going to be long enough to go over all of these concepts, but as time progresses, I will continue to share more in different videos about the concepts that I use to come up with my market outlooks. Also, feel free to check out ICT on YouTube. All the concepts I explain here would be covered in most likely a whole lot more depth in his content. So if we switch to the monthly, we can see that the month of January here has been a pretty bullish month. The month started here, is up here, and is likely to close somewhere up here as a bullish month. If you look a little back, we can see that we have a fair value gap, and that when price fell, it fell inefficiently. And now price has filled that gap. On a monthly time frame, I would expect price to want to turn around and retest this low and potentially fill this fair value gap after having traded into this one. Now, again, remembering that we are at the end of January and the beginning of February, from this perspective, to me, it looks likely that the next month will easily take the high of this month. Looking here at the weekly, this entire move up is an order block. It could be refined to higher points on it. However, the entire move does represent an order block. We are in bullish price delivery. So we can again expect this order block to want to send price back down, perhaps to fill some of these imbalances that we have below. Looking here at the daily, we have the 2023 open price over here. As we can see, we traded a bit above it, a bit below it, and have been expanding above it ever since. Now, if we look to the left here, we can see that we have taken the liquidity above this high and have traded into this daily fair value gap, which represents an imbalance. We can expect this to, when price trades into it, want to see price trade away from it and begin to seek sell side liquidity on this higher time frame. Looking at where that sell side liquidity may rest, we can anticipate that it may want to retrace back to fill this imbalance, this daily fair value gap. Or this is, I'm sorry, I'm looking at a 12-hour chart right now. So this is a 12-hour fair value gap. However, if we stretch to the daily, you can see that it is also an efficient price on that level as well. Looking back to the 12-hour, I'm just going to draw that out so that we can refer back to it when we are on smaller time frames. Now, that's usually good enough for a higher time frame outlook. I will generally just scroll through some other time frames just to see if there's anything that I may not have been paying attention to. So this is a bearish order block, and we may want to pay attention to that. If we are in shorts and price reaches there, it may be a good idea to either take some profit or close out of our positions entirely. Now we are on the hourly chart, and we're just going to do a little bit of a news outlook for the week. Looking for things that would affect the dollar primarily. You can see that the beginning of the week, there's really not that much high impact news. As we roll into Tuesday, we do have some high impact news at 10 a.m. late in the day on Tuesday. I'm sorry, that's for the New Zealand to dollar. On Wednesday, we do have some 10 a.m. news and FOMC at 2 p.m. News drivers essentially are what you can expect to move the price, to move market prices significantly. So it's always good to see what is upcoming on the calendar, just so that you have a reference point for what might be responsible for moving price. On Friday, as mentioned earlier, NFP will be happening. That is one to watch. More than likely, it's not one to trade. However, you are able to watch and see what the market achieves during this news event. So just returning back here to the 30-minute and looking at the week, having absorbed some high time frame perspective, recognizing that price is still currently in a bullish leg. I think it's reasonable to see this leg continue to expand until it reaches a point of exhaustion that is in line with higher time frame objectives, and then look to seek first lower time frame liquidity objectives and then higher time frame liquidity objectives. I hope this has been informative. I'll be back at the end of the week to post a recap on NAS100 and how it moved relative to my analysis. I'm active during the week on TradingView. My handle is at Akhenaten. That is AKHENA 10, the number 10, 10. There I post weekly outlooks for Euro USD, GBP USD, the dollar index DXY, NAS 100, as I did in this video, US 30 and US 500. If you saw value in the ideas shared in this video and would benefit from more concept breakdowns and market outlooks, like and hit that subscribe button. Stay safe and happy trading.